Hi, this is Keith Schneider, CEO of MarketCage.com, and this is December 20th edition of Market Outlook. So, pretty much close to the last edition of the year. Let's get right to it. Pretty volatile market, interesting reactions to the Fed announcement. It's got some historical precedents, and we'll take a look at that as well. So, first of all, Wednesday's action after the Fed announcement uh, was pretty positive. We were up probably close to 200 points plus in the Dow, but let's take a look at the S&P as our core index here. And as you can see, we basically, on the day of the Fed announcement, took out that 50-day moving average, and then on Thursday and Friday, gapped higher, closed with basically a bearish engulfing pattern, right? You can see here the bearish engulfing pattern means it gapped higher than the open of the prior day, and the body of the candle closed lower than the body of the candle on the prior day. Now, that also occurred right at the rising 50-day moving average, which meant that it could not hold at least for a couple days above it. The other thing is that in general, whenever the market reacts favorably on the first day of the Fed announcement of an initial rate rise, you then often get a correction, which now is running to historical precedents. But take a look at this really huge volume on the downside on Friday. Yes, it was triple witching. It was a reaction after the Fed meeting. It's end of year action. So not surprising, but we did have well over double the volume. We also had what you can consider is a breakaway gap. So there's a lot of negative movement here and a deterioration in trend. So the other thing to note, which is also you want to talk about a mixed signal, if we zoom in here, you can see the blue line, which is the 50-day moving average, is now above the green line. So you had a golden cross to the upside. And then correspondingly, a downward move. So pretty conflicting signal there, although I would go primarily with what the price action is, and huge down move on a gap under or a change in phase that's negative. The evidence is more to the downside. Now let's take a look at some of the other sequences here or time frames. What is interesting is that we're basically right at 200. We're down about 2% or so for the year, maybe a little bit more, not by much. And we're holding this blue line here is the 23-month moving average. And that is basically where we stopped on Friday. So interesting, long-term trend, we're sitting right on it. Next week's action is going to be pretty important. You can also look at the monthly charts here, and it looks like somewhat of a wedge or a pennant forming as well. So renewed sell through the lows on Friday definitely are going to show exactly where this market is heading, and that would be downward. In addition, we've got some interest here on the weekly charts as well, because one of our key weekly moving averages is the 65-week. And that means that now we've closed under the 65-week moving average now 2 weeks in a row. So definitely market under pressure. You can see the weekly volume here, which was to the downside, about the highest it's been since the big sell-off in August. So we have to keep an eye at the various time frames and how the charts are setting up there as well. Okay, let's take a look at a couple of other things here in terms of the market internals and sentiment as well. So first of all, in terms of market internals, we're pretty much at neutral levels on up-down volume. Now, we got pretty oversold just before the Fed announcement, a couple days before, and we had that really nice size rally, and then really confirmed at the day of the announcement on Wednesday. So you can see we hooked from oversold conditions with the exception of the advanced decline. So what's interesting is what's not participating in any way here is the advanced decline. Yes, we did come off of almost a minus 9,000 reading, but nonetheless, we really didn't even touch what I would call a trigger for oversold to turn into a buy. So we've got 2/3 of our indicators coming off deeply oversold conditions from the earlier part of the week, and then getting that rally and then giving it all up. So right now, we've got plenty of room to move for the indicators and the market internals. Can't really glean that much from it at the moment. We're sort of in the mid-range and still trying to get a confirmation in overall breadth, which we can't get. And that's sort of confirmed because we have probably less than 200 stocks. I'll tell you in a second here. We have about, in terms of stocks, under the 200-day moving average, it's something like 330 stocks are under the 200-day moving average. So that is not a good sign. Breadth is rather weak, and that whatever advances we're getting is pretty much in the NASDAQ 100 and those components that are part of the S&P 500 as well. So it's very, very, very narrow rally, and definitely a cause for caution. Let's take a look at sentiment. Again, sentiment came off of oversold conditions and has been working its way upward. But with the sell-off on Thursday and Friday, we're sort of trending back down again, but we're certainly not at extreme levels at all. So sentiment is sort of what I would call a neutral to more negative reading, as we did break down and close under the 3 and the 5-day moving average on the actual volatility ratio chart. Okay, so that covers sentiment, market internals. Taking a look at the calendar range on the spiders, you can see we are now trading beneath the 6-month calendar range, which of course will be reset in mid-January, but nonetheless, this is definitely the lowest close since the mid part of October, and the 1-month calendar range, as you can see, was set up around the 208 level. We're trading under that and under the 6-month calendar range. So market definitely under pressure here, looking at seasonals and the calendar ranges as well. Now, let's take a look at TAN. On a weekly chart here, the solar index has moved above its 200-week moving average and closed above it. So despite the fact that oil, right, which generally these two run together in the general trend, now there have been periods of time where solar energy, TAN, this is the TAN ETF, solar energy, runs ahead or lags, but on a historical basis now, considering that oil is at its lowest level in many years, and this has been bottoming and actually was up sharply for the week. We moved from a low of about 27 or so, all the way up to 33, or close to 33. Just I believe we just about touched the 33 number before selling off a little bit along with the general sell-off in the market. So TAN, solar energy, definitely going counter to the whole market. That's interesting. Certainly looks like bottoming action here. And on a ratio basis, TAN relative to oil prices is at its highest level ever. So solar energy, when compared to the sell-off in oil, even on a relative basis, is moving much, much higher and actually at historic highs. Let's take a look at the daily chart as well. In TAN, we looked at the weekly. Let's rescale it here. So even with the 300 plus sell-off in the Dow, you can see on Friday, the solar energy sector here, or ETF, was up over 1%. So again, really nice size rally. I guess we got down to almost 26, rallied up to 33, and would like to see this obviously get back above the 200-day moving average. But you definitely, with this breakaway gap here, if we can hold that, looks like we can certainly attack the 35 to 36 level, which coincides with the 200-day moving average. But this solar sector looks like it's certainly a leader and something to watch going into 2016. And again, this also occurred on huge volume. And over the last couple days, we had three really good-sized days in terms of volume. This ETF is definitely getting some interest. And it's interesting, in fact, that it is going so counter to oil and the market in general. So all eyes on this. Another key thing to watch is gold. The market remains under pressure. Obviously, gold hit a new multi-year low, and on Friday actually was up over 1% and might have put in some sort of bottoming action. Seasonally, this is also good for gold. So is this counter action relative to the market just a nervous reaction and a move as an alternative currency? Remains to be seen. But what is interesting, we did take out these lows here and did not follow through, even though there was pressure on oil, and oil and gold and commodities often run together. In this case, gold certainly diverged. Let's take a look at the weekly chart on gold here. Or even better yet, let's take a look at the monthly chart. And you can see on a monthly basis here, we basically closed sort of at this point on a doji. So even with the pressure in oil, the pressure in stocks, we basically closed unchanged, although we did hit relatively, on a relative basis, some of the lowest prices in GLD going back to 2009 this week. So with the action on Friday going counter, it's possible that we may have flushed out or we're close to seeing the lows in gold as well. So we covered, and let's take a look at one other thing, FXE, which is the euro. And interestingly, even with the rate rise, the euro basically closed slightly up on Friday, up about a 0.5%, sitting just below the 50 and the 200-day moving average. What is interesting is that certainly the economic monetary policies Draghi and the ECB is diverging somewhat with what's happening here in the US. So again, the point to watch, if we can get above the 108 level, which is the 200-day moving average, and also clearing a lot of the work over the last several months, including the attempt here in October at breaking that 200-day moving average and moving down pretty sharply. If we can get above that level, which corresponds to about 108.50 or so, and the 200-day moving average, that could signal an end to the US dollar strength. That's your key component. However, at this point, the trend is still intact as we are in a clear bear phase in the euro relative to the dollar, right? Because the 50-day here under the 200, and we are trading under it. So you are in a bear phase. So that is still intact. The key number to watch here, again, reinforce 108.50 level would tell me that the trend in the long-term trend in the dollar will resume itself to the downside. However, the shorter term, correction this year of the of a strong dollar against the longer term trend is still intact. That's it for now. Hope this helps. Certainly, you've got a very dicey market here. Historically, before the rate rise, commodity prices are generally already accelerating to the upside. Not the case. Similar in bonds. Over the last 6 months, bond yields and treasuries on certain parts of the yield curve are certainly flat to down in terms of yield. That's unusual when you get the initial rate rise. So definitely a lot of anomalies. Markets are not acting consistent with historical precedents, and certainly with interest rates still at a relative 5,000-year low. This is certainly historic period. So how the markets react to that is not exactly clear. The only thing we can go on, certainly, is the charts and let them tell the picture. Okay, that's it. Speak to you or see you next week, and have a great week. Bye-bye.